I want to say welcome and thank you everyone for joining us today. Our panelists and our audience. Now we had over 1,000 people register for this event. I know a lot of people are logging in and getting settled, so we'll give them a little bit of time for that. This is our 6th event that we've hosted with our economic power panel, all people and experts that you well know in the marketplace, but we will do an introduction. Just before we get started, I'll give you a couple of minutes just to get settled. Some housekeeping items. We are recording this and we will provide a link to that recording after the event itself. The audience itself has been put on mute. You can ask questions through the Q&A feature. Down in the bottom right-hand corner, you'll see 3 dots. You can pick up there. The Q&A part allow you to ask questions during the session. If you're having any technical difficulties, just put something in the chat and our technical team will help you get that worked out. The questions we have for today are about 40 minutes in length, and we'll have about 10 minutes near the end for audience questions, unless we can work them into the questions that we're asking as we go along. So panelists are always great at expanding the questions that we ask them anyway, so we may well cover some of those answers as we go through the process. And I'll say that while we plan these events months in advance, I have to say that this one is very timely given all the things that are going on in the marketplace and how quickly it's changing almost day by day. Now, I know it's difficult for anyone to predict what's going to happen in the market based upon current events. We're asking people to predict the future, and these gentlemen get asked to do it every day. I've even heard Benjamin say at one point that he gets so excited just before a Bank of Canada rate announcement, just because I think economists get really excited by something new to talk about. I think that's amazing. I will say that the bank did surprise some people with only, I guess I could say only 50 basis point rise in the overnight rate. But now that is done. And what does this tell us about where the market is going? So I think the important thing for us now is to get down to the reason that we're here, the Economic Power Panel. You know these gentlemen well. Derek Burleton, Vice President, Deputy Chief Economist for TD Bank. Robert Hogue, Assistant Chief Economist for RBC. Benjamin Tal, Deputy Chief Economist for CIBC World Markets. Welcome, gentlemen, and thank you for participating with us today.
Thanks.
So we'll jump right in. The first question actually for Benjamin. So we'll start at the global level and work our way down. And maybe you can tell us what your expectations are for the global market. Now, I know that's a big question. Are you expecting it to be global, maybe global recession, in maybe different countries reacting differently? I guess, are there...
So really, the answer is depends where you live. So I think that if you look at the overall situation, Europe is definitely in a recession under the weight of higher interest rates, energy prices, and clearly inflation that is higher than in North America. Then you have a situation in which North America is in a wannabe recession. It's not a real recession, it's a wannabe recession. What I mean by that is that you don't have the labor market participating in that slowdown that is coming. So it will be a very mild recession, if at all. However, that's a question of how high interest rates will be rising. I think that we are very close to overshooting when it comes to monetary policy. And every economic recession was helped, if not caused, by monetary policy error in which central bankers raised interest rates way too much and basically killed the economy. We are very close to that, and that's why I'm encouraged by the Bank of Canada not taking the green light that the market gave them to go 75, and they went only 50, basically saying, we don't want to overshoot. So that's encouraging. So we might be in a recession in North America, but at this point, it's a recession without the labor market, namely without a huge increase in the unemployment rate, and that's a good thing. China usually lifts the global economy, and that's not happening now. China is now functioning, operating at a trajectory that is similar to 2021 during COVID. Why? Because of the zero tolerance to COVID. In addition, the housing market there is basically softening in a very significant way. It's not like a 2008 US, but it's simply softening at a rate we haven't seen before. And for the first time, the housing market in China cannot lift the economy. It's basically the lack of ability of developers to raise money to build. It's really tier 2 and 3 cities. It's not the big cities. Nevertheless, it's really not helping. So the Chinese economy, if they are lucky, 3% GDP growth, that's basically a recession for them. So overall, the global economy is softening. And the issue is that it will not recover anytime soon. Inflation will be stickier. We'll discuss inflation later. And you have a situation in which you cannot have fiscal policy going one direction and monetary policy going the other direction. Basically, fiscal policies in Canada, the US will actually have to be joining monetary policy to slow down the economy. You cannot sabotage monetary policy, because if you have spending coming from the government, it's like putting a humidifier and a dehumidifier in the same room and let them go at each other. That's not going to be very, very productive. And therefore, I believe that you have to look at the 1980s. The only time that we actually started winning the war against inflation was when fiscal policy joined monetary policy. And that's exactly what we're going to see. Another reason why I believe that the recovery of the global economy will be slow. And that's a challenge that we're facing now. That's more or less where we are.
All right. Well, thank you very much. Now, maybe bringing it a little bit closer to home for Derek, just moving on to the Canadian outlook. Whereas Canada, are we headed for a recession 2023 or not? And if so, how bad do you think that might be?
Yeah, I do want to pick up on some of Benny's comments, because I think he's made an important point on duration. A lot of the focus has been on, will it be a recession in 23? Will it not? You know, I guess when I take a step back and look at where we've been, economy in Canada's had a great run, at least in the first half of this year. The expectation would be that it couldn't last forever. Some of the commodity tailwinds had ebbed, but more importantly, just the impact of rate hikes on housing, on household finances. You know, the expectation was we were going to quickly see a sync up, and we are already. I think the question is, as you asked, Joel, is how weak is it going to get, especially with rate increases affecting the economy with a lag, some of the renewal shock likely to get worse as we move into the coming quarters and the like. So that recession definition, you know, the usual definition is 2 quarters of contraction, higher unemployment rate. That's got to be part of it. Our last forecast, we didn't quite meet that definition, but it does appear that we probably will. You know, I think we will, as we move into next year, start to see the positive shift into negative. Nobody I know on the street is calling for a deep recession as of yet, but certainly that stagnation may tilt a little bit negative. But coming back to that question on duration, I think to get wages down, unless you have a very sharp recession, which again, I don't think is going to happen, you're going to need a significant period of softness, of stagnation, just to bring wage growth down. And you know, our forecast, we didn't have a steep recession next year, but our 2024 outlook wasn't for any bounce at all, pretty much, you know, moving along the zero line and unemployment rising further into 2024. So that's the kind of period we're in. I think personally that 2 years of stagnation is probably worse than a sharper short-term recession, just given that the longer it goes on, starts to eat away at corporate balance sheets and the like. So, I mean, that's an important point to throw out there. Now, could it be even deeper? I think that's probably where the focus is going to quickly shift to, away from, is it going to be recession or not? How bad is it going to get? And, you know, that's a difficult thing to call for. We worry about household balance sheets in particular. So hopefully the Bank of Canada stops sooner than later, because the higher rates go, higher inflation goes, obviously increases the risk of, you know, amplifier effects and the like. But for the time being, I'm okay with our forecast of kind of 2 years of stagnation with perhaps a mild technical recession in the economy next year.
Okay, thank you. Moving on, I think to Robert, maybe even a little bit finer in terms of the provinces. Now, not all the provinces seem to be reacting the same way, just like the housing market, reacting the same way to the inflation and the increase in rates. So from a provincial standpoint, do you have any comments on those?
Right. And no, we do agree that there's going to be a significant softness in the overall Canadian economy. We were amongst the first one to call it a recession, but really in effect, I would say most economists were more or less very close, whether it's a small positive, a small negative. And at the end of the day, you know, the big picture is not that different. But we do think that the labor market will soften enough to, you know, so that we can call it a recession. I think we have our unemployment rate in Canada rising by somewhere between 1.5 and 2 percentage points. So ending next year somewhere between 6.5 and 7%. So it would go, no, that would be enough for us to call it kind of a broad weakness in the economy. Over and above that, no, two consecutive decline in GDP. And obviously, across Canada, we'll get a diverse kind of set of outcomes. Our view has been that the economies that are most sensitive to interest rates, the provincial economies are most sensitive to interest rate, will be the ones that will show the greater weakness. And here we're talking, mainly in kind of Ontario and BC, where household debt is highest. Parts of Canada that are now sort of benefiting by stronger commodity markets, even though they're we're off the peak, but still historically pretty strong. And here we're talking more in the prairies that the economy there is doing pretty well, actually. And after last year, part of the weakness last year was the horrendous crop conditions, and those have reversed, and we're going to see this more support coming from the agricultural side. So we're more bullish on prairie provinces, Alberta, and especially in Saskatchewan. Mind you, Saskatchewan is, in terms of size of the economy, is pretty small, but we're likely to see a fairly sizable pickup. And Quebec, we thought would do relatively well in circumstances, but recent estimates of GDP from the provincial statistical agency almost make it sound like Quebec might be heading into a recession earlier than others. We're a bit skeptical about those numbers, but the point is, even though in Quebec is probably less sensitive to higher interest rate because household debt is not as high there, it's not immune, and we're likely to see a significant softness there. Whether it's going to go into kind of a full-blown recession, it might be a close call there. And Atlantic Canada is going to be likely to do relatively well, in the sense that it is finally benefiting from significant population inflows after decades and decades of net outflows, and that will continue to contribute to the economy there. But it's mostly the weakness where we're more concerned about, and is mostly Ontario and to some degree BC as well.
Right. It certainly is sort of, I guess, reminiscent of what's going on in the housing market as well, in those particular markets that are out there. But we will get into more of that. Benjamin, back to you on the interest rates, the inflation in Bank of Canada. Can the Bank of Canada pull off a soft landing? They came, I think, at the 50 basis points, maybe less than what some people said. You mentioned that. Maybe you can give us your thoughts on that.
Yes, that's a good one. Listen, I think that when it comes to inflation, at the end of the day, although we'll talk about inflation a lot, and we are talking about inflation a lot, it's all over the news. At the end of the day, this is really not about inflation. This is about the cost of bringing inflation down to 2%. That's what it is. Because 2 or 3 years from now, I think all the forecasts, it will be 2%. The question is, what will be the cost? You give the Bank of Canada 2 options. One is a recession. The other is inflation, and inflation expectations rising. They will take a recession any day. That's the reality that we're operating. They will do whatever it takes to make sure that they meet the target. For 40 years, the Fed, the Bank of Canada, the ECB established their reputation as inflation fighters. They're not going to toss it away. Yeah. So that's the direction we are going. They will do whatever it takes. Now, the inflation story is complicated because it's all about not inflation today, but what you and I think about inflation tomorrow. Inflation expectations. That's where the fight is. Now, it's interesting that those expectations, a large part of it is a reflection of 4 prices. 4 prices: the price of bread, the price of milk, of course, the price of beer, and gasoline prices. In addition, and that's not a joke, that's a reality based on surveys, the most credible source of information to households regarding inflation, the most credible source is social media. Social media, not TV, not social media. Now, the good news, and that's very good news, the Bank of Canada has a Twitter account. The bad news is that nobody's following them, which means that you have a situation in which the Bank of Canada cannot tweet its way out of inflation. They have to show us that they mean business, and that's why they went 100 basis points. That's why they were so aggressive. The fact that in this environment, in which you are trying to convince everybody that you are not behind the curve. You decided not to take the 75 basis point and you went with 50 is very, very encouraging. We have to remember that the reason why we have seen those recessions in the past is the fact that inflation is a lagging indicator. Inflation is telling you about the past, not the future. If you go over the past 5, 6 recessions, inflation peaked 6 months on average after the beginning of the recession. So it's telling you about the past. But show me the central banker that will have the monetary policy guts to stop raising interest rates while inflation is still accelerating. That's more or less where we are. And the Bank of Canada telling you we are actually starting to slow down, that's very encouraging. Now, to the extent that the inflation will be sticky and it will not happen, that's a tricky situation to be, because you always know that you were overshooting only in retrospect. You don't know that in real time. And that's more or less where we are. So what is our forecast? Our forecast is basically either a soft landing or a mild recession. We don't see a significant increase in the unemployment rate. We believe that if they stop at 4.25 and stay there for a while, and they will stay there, in my opinion, for at least a year before cutting interest rates, and we can discuss it later. But we have a situation in which, if that's the case, then the labor market that is extremely tight will start bleeding vacancies as opposed to jobs, because we have a buffer of 1 million vacancies that, I'm hearing that businesses are paying people to show up for an interview, paying them just for the interview. It's a crazy market, a very tight labor market. So if you have a situation in which you can shed vacancies, basically you're not hiring, but you're not firing, that can lead to a mild recession without the labor market participating in a very significant way. But if you go to 4.5, 5.5, and that's a real risk, then you are in a real old-fashioned recession with the unemployment rate joining. That's the way I see the situation.
Okay, very interesting. I'll leave it open for the other two gentlemen there, and maybe if you could work in some thoughts on where the Fed is going and its impact on our rates.
Yeah, we may be a little bit different. I don't know. We actually have built in some rate reductions at the end of next year. And I know our forecast wasn't particularly bleak. We did have the Canadian unemployment rate jumping by about 1.5 points, something I didn't mention before. So that's a relatively outsized move. Doesn't take it to 8% or anything, around 6.5. But I think one thing that came out of last week's meeting, a lot of focus in the monetary policy report on the household. The Bank of Canada's now building in some modest contractions in consumer spending, but just clearly more focused on some of the building household financial risks. So if we do get inflation moderating, and to Benny's point, I do think, his point about the fact that it's really about economic impact at this stage, we will get inflation coming down. That if we get inflation falling, then I do think the Bank of Canada will be ready to start cutting rates by the fourth quarter next year, the fall. But markets will build in expectations that earlier, and we actually have the 5-year yield coming down fairly steadily next year, and that should hopefully provide a bit of underlying support to the housing markets. So that's one thing I'd throw out. Just on the Fed, I think it's pretty much a done deal, 75 basis points tomorrow. We don't see the Fed pivoting as much as we heard from the Bank of Canada anytime soon. I think the Fed is going to be very worried about financial conditions. And we've seen bond yields fall back just on the notion of this pivot. And I don't think they'll want to see that. I do think they will make the pivot between now and the December meeting, but I don't think we'll hear much of that now. But we have a 4.50 peak on the Fed and a 4.25 peak on the Bank of Canada.
Right, and the Fed is dealing with a core inflation that's a bit more problematic than it is in Canada, and so we've got pretty much. I mean, our terminal point rate in the U.S. is 4.75, and we've got Canada at 4. So one more rate hike in Canada, and the broader outlook is more or less has been described here, and we just took out a rate cut at the end of 2023 in Canada. It's a bit of a toss-up whether it's going to happen at the end of next year or in 2024. But at that point, I agree. I mean, after the economy has cooled substantially, at that point, inflation should be down quite significantly and trending in the right way. Our view is that there will be clear signals for the Bank of Canada to start to rein in and reverse some of those rate hikes and get into that neutral rate zone of between 2 and 3%. So, but that getting there is more of a 2024 story.
If I may, one more thing about Canada versus the US, the Fed versus the Bank of Canada, and I'm talking here about the effectiveness of monetary policy. We have to remember that the Bank of Canada is more effective. Why? Because we simply have more debt. You have to go back to the 2008 financial crisis. We went through the mother of all deleveraging in the US. Canada, we haven't seen it because it was not our recession. In many ways, we were basically secondhand smokers back then. So you had a situation in which our debt level went up, theirs went down. So the Bank of Canada is more effective in a very significant way. So the tiny Bank of Canada is more powerful than the mighty Fed. And therefore, we see the Fed actually going above the Bank of Canada, consistent with your forecast and beyond, because simply you need more rate hikes with the Fed to get the same level of activity relative to the Bank of Canada. That's one thing. The other thing, and we're always searching for good news, there is a little bit of good news about the effectiveness of monetary policy in both sides of the border, and that's really due to the fact that the share of supply-driven inflation is going down. At any point in time, you have three sources of inflation: demand-driven, supply-driven, and we don't know driven type of inflation. But overall, it's about 50-50. And what we are seeing more and more with supply chain improving, and it is improving, shipping costs going down. Today, you have 20% more truck drivers in the US than before the recession. It's improving. We all know that. If you look at the US, the New York Fed supply chain index, it's improving, which means that the share of supply-driven inflation is starting to shrink, which means that the share of domestically oriented inflation is rising. And that's a good thing, actually, because it means that the Bank of Canada can do something about it. The Fed can do something about it. The effectiveness of monetary policy is rising because the Bank of Canada can talk about inflation until they are blue in the face. If you have a situation in which it's coming from outside, there is nothing they can do about it. And you raise the probability of a policy error if that's the case. If more and more of this inflation is domestically oriented, then you can do something about it. And that's more or less where we are. So I'm actually encouraged by that the supply-driven inflation is starting to slow down. And let's hope that it will be fast enough to prevent a monetary policy error.
Right. Let's move on to the housing affordability and house prices. So for Robert, I'll make it no secret, I'm probably more of an optimist on where the market is versus what the media is saying. I think the media sometimes overplays that, but that headline of, well, there's not much going on in the housing industry is probably not much of a headline that the media would pick up on. I think that certainly the average prices are coming down where people are buying less expensive homes. That doesn't necessarily translate to 123 Main Street is worth significantly less than it was in February, although certainly some parts of the market that is going on. I do think there's that perception out there where people are waiting for interest rates to peak and housing prices to bottom before they get back into the market. There's a lot of people seemingly sitting on the sidelines. So maybe we can talk about that in relation to both your housing affordability index, maybe first, and then into where you see for resales in the marketplace.
Right. But just off, I think prices have come down. Home prices have come down, and so there is that mix of activity that plays on the average price. But when you look at the MLS HPI or the RPS HPI, more of a benchmark price, a better representation of actual prices out there, those prices are coming down. So unfortunately for buyers out there, I guess the benefit of lower prices is being or has been overwhelmed by higher rates that they're paying. So at the end of the day, those mortgage payments for a home that's available out there are still higher than it was before, not to say a year ago. So affordability has deteriorated, and that's been the case pretty much across the board across Canada. Now, obviously, the starting point was very different across the country. Some parts of the country where ownership costs as a share of income were already very elevated at before the pandemic. They got worse, and more recently with interest rates rising, it meant that that's got even worse, because those where affordability was stretched are high priced markets where a 1 percentage price increase in a 1% percentage point increase in a mortgage rate means a lot of dollars, because the size of the mortgages are huge. But there are many markets across Canada, not just from a geography perspective, probably most markets are still pretty affordable. But there are smaller markets in terms of in terms of the housing stock. And I'm talking about many of those markets in the prairies, and some in Atlantic Canada, and some parts in Quebec as well. So there, even though affordability has deteriorated over the past year, especially this year, it's still not overly stretched in most cases. Maybe Halifax is starting to push the limit a little bit. But generally speaking, those are still relatively affordable. And to a certain extent, it does explain some of those population migration movements that we've seen over the past year. Now you're seeing, and in fact, when the latest census numbers have shown that, for example, in Ontario, you've seen a fairly significant outflow of people from the province into parts of Atlantic Canada, for example. And I bet, and to a large extent, this is a search for affordability. Many people go there either buy a home or even from a rental perspective. So those are kind of the larger kind of pieces of that puzzle from kind of affordability. Now, on a go-forward basis, I think those price declines that we're seeing will start the moment that interest rate will reach that peak and will plateau for a period of time. The price declines will now flow through into affordability and will start to make things more affordable. I'm not suggesting that, for example, the GTA market will become affordable the way housing is affordable in St. John, New Brunswick, but there should be some relief there, and that could be the signal for some of the buyers you were talking about that have been on the sideline, and these are, I would argue, maybe mostly investors, because for first-time home buyers, it's still going to be pretty onerous in most cases to get into the market for a little bit longer. But there might be some who are trying to be strategic here that could see an improvement or signs that an interest rate have reached their peak. Prices are, maybe the price declines are starting to slow down. That might be their cue to go back in the market, and then that will start that recovery or the bottom forming, and which in our view, we're talking probably the spring of next year.
Okay, Derek or Benjamin, any thoughts on house prices, markets?
Go ahead, Benny.
No. Okay, the way I see the situation is that it's not done. I agree that the process is ongoing, and this is not the end by any stretch of the imagination. We have to understand how to define it. People are talking about a crash, a meltdown, a correction. It's not. You have to go back to the COVID years when we had the prices rising by 46% in 2 years. If you have 46% increase in average price in 2 years and you are not slowing down and you are not softening, you are in a bubble. Let's call it as it is. So this slowdown is very healthy. It's actually a good thing. We have to realize what happened during COVID. All the jobs that were lost were low-paying jobs, as we all know. Young people, renters, and that's why during the early stages of COVID, rent actually went down. Now it's going up, but it went down. Home buyers, potential home buyers, they were zooming. Their position was there, their job was there, and interest rates were very, very low. So you had the situation in which home buyers, and that's key, home buyers got the benefit of a recession vis-a-vis extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. We have never, never, never seen anything like that. There was a sense of urgency to get into the market. And by the way, as we all know, parents told their kids, you do that, and we will help you. Gifting reached a record high during the pandemic, as we discussed in the past. So when you have a sense of urgency to get into the market, you front load activity, you borrow activity from the future. and the future has arrived. We are in the future. The future has arrived vis-a-vis higher interest rates. So this is not a crash. This is not a meltdown. This is reallocation of activity over time, responding to higher interest rates, and it's extremely, extremely healthy. I know that people will not like it, but when I see every month prices going down, I cheer. It's right. It's the right thing to see, because we need to bring this market to balanced position, and in many cases, it's back to balance, and that's a good thing. I see it continuing over the next few months. I agree that it will probably start stabilizing around the spring, with interest rates stabilizing. Developers are telling me, listen, we are canceling not because of the fact that interest rates are high, but because of the fact we don't know where we are. We need some clarity. The minute we get the fog clears, I think you'll see developers going back to the market. For now, clearly, the lack of supply is a major issue and will continue to be an issue.
I guess I just add on the supply. I think that's going to be key. Really, no evidence of all of forced selling. When we move into next year, we do run into more of the renewal issues, renewal shock and the like. Very important to track active listings, new listings, which, as mentioned, really haven't moved very much. Really, most of the action in terms of the affordability hit has been on lower demand, lower sales. So with supply holding firm, the sales to listings ratio hasn't really moved aggressively into deep buyers territory. So as I say, I think that the key will be next year when we get some more of these impacts. You know, the hope is that we'll get through it and demand will stabilize first and limit some of this potential for feedback. And I'm no different than others. I think, you know, by the time, provided we do see a peak Bank of Canada rate by the end of this year, by the spring market of next year, we should start to see some stabilization on the demand front and an improvement, albeit a fairly limp one. Again, going back to my economic outlook, but some improvement, and that should help the market at least stabilize. So it'll be interesting. And just on the home building side, very little slowdown in starts. I wonder to what extent that is a reflection of the delays in Ontario GTA market through permitting and the like, that it's just a very slow moving mechanism there. But clearly that we're not going to see starts hold up at these levels, and that should show some fairly significant pullback in 2023.
Right. We'll actually come back to new builds and some more questioning on that in just a moment. I do want to get to that point of the mortgage arrears rates and the renewing at higher rates and potentially the impact there. Maybe from Benjamin, your thoughts on the maybe homeowners that are most at risk for arrears or that type of thing, what the expectations are?
Yes, so we know that the COVID cohort will be the one that is going to be suffering the most in renewal. People who took a mortgage in 2020, 2021 with zero interest rates, basically going to see a major shock. And that's why I know that all banks are very busy actively calling them and say, listen, if you can accelerate payments now, that would be a good idea, because you're going to see a shock 2 or 3 years from now. And that will be a major shock. Even if interest rates will be going down, and they will be going down, I don't see interest rates going back to where they were, namely before the COVID. We have some inflationary forces that are more permanent. You know, before the crisis, we had globalization, just-in-time inventory, and we had wages that were not very aggressive. The opposite is now happening. You have deglobalization, you have just-in-case inventory, and you have wages that are rising and the labor market very tight. That will continue to be the case, and that's something that will generate some sort of inflationary forces, which means that in order to keep the inflation rate at target at 2%, you need by definition higher interest rates than before. So if before the overnight was 175, and we are going to 4.25, we're going down, maybe we'll go down to 2.75, call it a day. That would be a full percentage point higher than before. We have to get used to it, and that's something that will impact those borrowers. Are we going to see a wave of defaults? No. I think that we are going to see some increase in defaults. It's not going to be 2008 financial crisis in the US by any stretch of the imagination. The stress test was a very important tool protecting the market, and I think that was extremely good. I think that we have to adjust, update this tool, but that's a different story. I think that we are going to see some increase in delinquency rates, no question about it, but it's not going to be a question of default. It's going to be a question of spending. As long as the labor market is there, You will see people simply spending more on financing their debt, less on consumption, going back to Derek's point about the duration of the slowdown. Namely, the recovery will not be very strong because of the sensitivity to higher interest rates. I see the delinquency rates rising, but not to the sky by any stretch of the imagination.
Okay. Let's move on to new builds, or back to new builds and some of the construction thing there. And for Robert, we've heard of a number of maybe more condo projects in particular getting canceled because of rising costs and things going on there. But there seems to be a lot of input pressure on getting more new builds going. So if you can share your thoughts on where that's going.
Right. And those cancellation, my understanding, most of them were a project that were going to be announced and they decided not to proceed. I don't think they were those necessarily at marketing, but clearly higher cost of construction is a big deal. So I think this is where, and due to materials, but also the labor shortages. So I think that those are huge consideration. In terms of activity, as it's been mentioned, like housing starts are still very strong as we speak, and that's a reflection on pre-construction sales of the past, and that's fueling also a lot of activity in terms of units under construction at record levels nationwide, including in the major markets and across Canada. Now, when you look at the more recent pre-construction sales, this is where things got incredibly quiet, especially in the GTA. If you talk to new developers, things are pretty much dead, or less. I just saw some numbers for September, and things are now sales are down more than 90% year over year for that month. So extremely quiet. We've seen episodes like this in the past, sort of perhaps not to that magnitude, but this is not a kind of a nice smooth process. There are ups and downs over the course of the year. So maybe, as was mentioned, if when the fog lifts, there might be a more action taking place on that front. But certainly that signals that construction may slow down in a year from now or a couple of years from now down the road. So those starts are likely to slow down. Now, the concern is that if we see too much of a slowdown at the time when immigration is coming, is ramping up big time, and there will continue to rise because immigration targets are higher, then we're not addressing that supply shortage issue fundamentally from a new build perspective, and that's likely to bring back those what we were all talking about 7 or 8 months ago, that we need a lot more units out there and we need to build a lot more. This is where my worry is that if the pre-construction things slow down too much, may translate into too much of a weakness at a time, like down the road, at a time where we'll need it more than ever, more units to satisfy demand.
Right. There's so much going on there. Let me go back to one thing, actually, Benjamin, that you had mentioned, I think, on rentals and where that market's going. During the COVID, the rentals actually went down. Now they seem to be the talk of a lot of media and industry players out there. You can give us your view on the rentals.
Yeah, that goes back to the point about supply and the fact that we are not building. Again, I'm very concerned about the fact that we are canceling projects now. A lot of them are in purpose-built apartment buildings. A lot of cancellations there. I spend a lot of time with REITs that try to make money in this environment. They show me the spreadsheets. They cannot make money. They simply cannot make money. And the government saying, all those millionaire developers, they can take it. No, they cannot. They will not build if it doesn't make sense to build. And you know where they will build? In Manhattan, in Phoenix, Arizona, in Florida. And that's exactly where the activity is going. And we are losing. And I totally agree. We are not building now. We are actually canceling projects or delaying projects. The demand is coming. The first 6 months of the year, we got 270,000 new immigrants. We are getting tens of thousands of people from elsewhere on the 3-year visa. We are talking about almost 500,000 people entering the country in 6 months, and they're not carrying their house. on their back. So we have a situation in which the demand is there, and when the fog clears, the supply will not be there. So you don't have to be an economist to predict what will happen. So we have a situation in which we have to wake up on this, and especially with purpose-built. And what's happening in Ontario, the changes, the most significant changes to housing policy in recent history, in my opinion, very positive, not enough, but going in the right direction. But I'm very concerned about the lack of pre-sales and the lack of activity in the purpose-built rental apartment building, because that's what we need. So the rental market will be tight, will be under pressure, and then we'll hear about rent control and the need for rent control, and it's coming. And again, rent control, although I know where it's coming from, it's exactly the opposite of what you need to do. Exactly the opposite. We have seen it in the 90s, and that killed the purpose-built rental market. And if we start to introduce it again, that will be a disaster, because developers are not building now. They definitely will not build if there is rent control. So you're basically subsidizing current tenants at the expense of future tenants. That's not the solution. The solution is the opposite. Provide incentives to developers to build more, sell land to purpose build as opposed to who is paying more, provide tax incentives. There are many things to do to make sure that it makes sense to build, especially if you don't own the land.
Right. Now, it's an interesting dynamic, just the number of people coming into the market, maybe the shift from single family homes for families into condominiums that have only gotten smaller in their size, as well as all the students coming back into the country over the next, not just this year, but into next year, driving up the demand for that. Do you see a change maybe in the direction of what they're building? So are there going to be slightly bigger condos, more purpose-built? Even for age groups, it seems to be some dynamics moving there.
Yeah, I think that, yes, I think that that's the only way to go. You basically have to look at the rental market as the new way to deal with the affordability crisis. As we discussed in earlier conversations, I think that a rental solution must be a big part of the overall solution, and it has to be apartment buildings, and that's why we have to provide incentives, not just those small units that we are building. I believe that the nature of immigration is very different. We are talking about record high numbers of new immigrants are coming. Last year, as we discussed, 70% of those new immigrants arrived from one country, 70%. And that country was Canada. How can you get people from Canada to Canada? They were already here. They were foreign students. Their visa expired. The government went to them and said, "Don't worry about your expired visa. When while you wait, why don't you apply to be a permanent resident?" They are more employable because they speak the language. They are more educated, and that's something that is going to change. And the sources in government are telling me that that's the trajectory. The trajectory is basically to get more people arriving to Canada from Canada. This, of course, has major implications for employability, but also on the propensity to buy a house. And I think that people in the housing market have to realize that this is changing. By the way, how many construction workers did we get out of those new immigrants? Zero. How many nurses did we get? Zero. So we have to start rethinking, as a footnote to the footnote, I will say, rethinking the point system to make sure that there is a bit better alignment between what we need and what's coming. But overall, the trajectory is positive in terms of demand, and that's why we need the supply.
Okay. Why don't we move on now to advice that you might give to the government on what they should be doing next? Or for Derek, what are some of those actions that you may see the government taking over the next little while?
Yeah, sure. Just one quick thing on Benny's point, just to extend it out. I guess one silver lining of the slowdown globally and in Canada is that cost pressure should moderate quite a bit, and within the labor market, we should see some, easing up in some of the tightness there. So, from a longer term building perspective, a lot of focus on government policy on rent controls, but the economics of some of the projects should improve if we get that. And we are that cyclical downturn. So I think that's certainly one point to emphasize. In terms of regulatory, I don't see a lot happening anytime soon. I mean, some of the regulatory moves were already announced, and it's really, by OSFI, for example, on combined loan products, things like that. The banks and institutions are working towards, clearly more focus on variable rate mortgages, some of the issues around, target rates and target points and the like. So that's certainly going to be a focus by OSFI, and we may hear something or more on that front going forward. One of the big questions remains B20 and whether OSFI will do a review of B20, and there's some rumblings that maybe in 2023 they might, but I think a lot will depend on where we are in the housing cycle. The qualifying rate, for example, probably a bit counterintuitive to change it right at the stage where there's still upside risks on interest rates, in the economy with inflation high. But once things settle down a bit in the market, maybe looks like it's primed for recovery, maybe they do revisit some of these restrictions on qualifying rate on the insured mortgage cap and the like. So we'll see on that front. And the federal update on Thursday, I'm not anticipating a whole lot. I mean, the government may reiterate some of its commitments on the Housing Accelerator program and the like, but don't see anything too much coming from that update. It's going to be more of a refresh of the deficit numbers than any kind of big policy push. I guess the only other thing, Joel, I'd mention on regulatory, just that Ontario housing plan, just to reiterate, the point that this is quite a fairly comprehensive and bold plan. The government's got, hugely aspirational targets to raise, building starts by 1.5 million new homes over the next 10 years. If you look back over history, that would be multiples of past peaks. So certainly I would view it more of an aspirational target, but, they seem to be hitting most of the key points there in terms of some of the regulatory barriers. Now, obviously, it'll come down to execution going forward. But one thing I'm hearing, just municipalities, they're not happy with. Now, development charges is a huge cost for developers, just accounting, and we know they're too high. But there's some unintended consequences in pushing development charges lower. How will municipalities come up with the revenue? It's going to put pressure on their property tax systems. And, like usual, sometimes the policy isn't as broad as it needs to be. You're getting into questions around infrastructure support and the like. A lot of this is delivered by municipalities. And, the policy, again, is broad in terms of creating new supply, but, not sure it goes as far as addressing a lot of the infrastructure challenges long term. So there may be a 2.0 that needs to come out of all this, but at least a good push on that front, that at least we're seeing a tailwind there and moving in the right direction.
Great. How about Robert and then Benjamin, your thoughts on any government regulations coming?
Well, but just starting by a general point, I mean, I feel encouraged to see all levels of government basically agreeing that focusing on the supply side is the right thing to do, which is not something that until I guess the federal budget last spring was the case. So I think that's a step in the right direction now. And I also agree that what was announced in Ontario is also a step in the right direction. I mean, a lot of this at the end of the day, lies at the local level and the municipalities, and there's development charges is one aspect also, but this whole thing, this whole issue of zoning, I think is another major one to do infills and to address the missing middle. And so that's again, and I totally agree with Derek. It's more kind of the aspiration is fine, but also it'll be down to the execution to get things going and get municipalities to move ahead on this. Now, in December, OSFI is supposed to review the qualifying rate for the stress test. So it'll be interesting. It might be still a bit premature to see any kind of movement or make it a little bit more flexible or to ease it. But I think it's fair to launch the conversation about making it more flexible. And that's a criticism, a longstanding criticism of the stress test, to make it a bit more flexible over the economic cycle. But it'll be interesting to see what they'll have to say on this. I just spoke this morning to a whole bunch of the group of realtors, and they were asking whether it will be completely discontinued and everything, and I don't see that happening. But there might be some signals that the qualifying rate is very stringent at this point, at the time when interest rates, the likelihood of further increases in interest rate has diminished greatly relative to 8 months ago. I'll leave it at that for now.
Okay, and Benjamin.
Yes, they can do many things. We don't have the time to go over the list, but a few things in general is, first of all, remove politics from the zoning process. Remove the politicians out of it, because they don't have any incentive to improve the situation because they want to be re-elected. So make it basically people that are in charge don't have to be re-elected. Remove politics out of it. I think that's something that will really lead to something much better in terms of results. The other aspect is coordination between the federal, provincial, and the municipal governments. Clearly, municipalities need the money. They are totally addicted to development charges and HST, but at the same time, they cannot raise money. Either allow them to run a deficit, which I don't think is going to happen, or let the federal government support this kind of activity and allow to eliminate the development charges and HST. Again, I told you I meet with a lot of REITs and developers, and I go through the spreadsheets. In every exercise, you remove development charges and HST, and all of a sudden, from a no-go, it's a go. It makes a difference. So if the money comes from the province and the government, the federal government, to municipalities, that can help. So a lot of things we can do, many low-hanging fruit out of there. We just have to be creative, provide incentives for land owners to sell to purpose build. Excess land by the province now being sold to whoever pays more. No, sell it to purpose build. There are many things that we can do to really ease the problem. We just need the courage to do so.
Right. It is such a big issue, and lots more to come on that, I'm sure, in the next little while. We're almost near the end of our set questions, and this is one of my favorites. I usually end with is that if you had to invest your own money in housing somewhere in the country, where would you be putting it? Or just as interesting, where wouldn't you be putting it?
Well, I will start with, I know that industrial is expensive, super expensive, but at the same time, it is, dominated by demand that is not very price sensitive, and there is no supply whatsoever. So I know that the prices went down in some pockets, and they will continue to go down when the economy slows down. I will wait and then get into this space from a long-term perspective because I think it's very good. That's one thing. The other is that I will stay away from office at this point, especially tier 2 and 3. And I will be very careful with retail. Only high quality retail, I think, will do very, very well, but not the other way around. I think that when it comes to rental, I think that rent will continue to rise. It's very tricky because there is always the risk of rent control and other restrictions. But I think that if you remove that risk, apartment buildings, multi-residential can do extremely well because I think that rent will continue to rise.
I guess geographically, I'd be looking, because we won't have all, and Robert spoke about this before, not all economies will be moving exactly in sync over the next few years. I do see a bit more strength in the prairie region. He spoke about some of the strength in agriculture. Oil and gas should continue to hold up quite well. So either Alberta, Saskatchewan might be my regional choice. And then, the rental market certainly seems, the pendulum has been swinging towards it, maybe a bit away from home ownership after quite the run we've seen. So maybe something on the rental side might be my area of choice.
Fair.
That was actually going to be my answer.
Royalty.
Oh, Wes, I think Calgary looks pretty good. Calgary looks pretty good right now, and rental, it's more than, it's pretty much across the board, and including smaller markets. And I know earlier in the conversation there was a comment made that the rental segment fell early in the pandemic. It actually fell only in the major cities and in the downtown core. The rental market, got really strong really early in the smaller markets across Canada, because it was largely that movement of folks exiting the downtown core into the more affordable, or going back to the mom and dad in the regions that they came from originally. And so I would be bullish on the prospects. And you hear stories in small town Quebec, just like no apartments available. So I think that the residential rental market across the board, I think is it looks pretty promising over, I would argue, even over the longer term.
Okay, maybe a subset of that question, this might be too personal, is that what kind of mortgage rate would you take?
Right now, I think that I'll say exactly what the market is saying. The market, most of the market are going for 2 to 3 years fixed right now.
Sounds like that sounds good.
All right, that's the end of our set questions. We do have a couple of questions coming in from the viewers or the participants there. Just one question on inflation and its impact from the post-pandemic recovery and Russia. So is that as big an issue now as it was previous, or is the world starting to adapt to that situation?
I think Benny touched on it well, I thought, where he talked about there's the externally driven inflation, which is, the wheat prices due to the Russia-Ukraine war, oil, these are global commodities and global pressures that Canada imported. Nobody was immune to it. And then you have the other part of it is the domestically driven inflation, which includes shelter and a lot of the wage-driven service inflation, the like. And we are seeing evidence in Canada that external, which accounted for more than half, well over half at its peak, has begun to roll over. But it's being replaced to some extent by the domestic-driven inflation. So the bet is goods will come back quite a bit. The external will come back quite a bit. And even though the domestic may have a little bit further room to run, as we get into next year, that too may start to roll over as job markets slacken up a bit.
Okay. Any other thoughts on that? Just
on that domestic side, I think what we're going to be looking at very closely is that wage feedback loop into inflation, because we're seeing likely workers or their union representative will push hard to recover their purchasing powers that they've lost over the past year, and so that there's probably a bit more that will come on that front. Obviously, the Bank of Canada is that'll be part of its battle is to address that as well.
So
right.
Two more things very, very quickly on that. One is that totally agree that the supply story is going to be less significant when it comes to inflation. But at the same time, we have to realize that from a long-term perspective, those forces will take inflation higher, or the inflationary pressure higher, and therefore you need higher interest rates to keep them down. And some people will start tweet about the possibility of, why don't you raise the target to 3% or 4%? Not going to happen anytime soon. So in order to keep this rate at 2% and the inflationary pressures that are coming are more significant, interest rates will have to be higher than before. That's one thing. The other about the wage story. It's interesting because most of the demand for workers, especially the vacancies, is among low-wage workers, occupations. Now, Economics 101 says that if you have demand and not enough supply, the price, namely the wage, will rise. But it's not rising faster than any other wage group. So something is happening here, and businesses are unwilling or unable to pay more to those bottom 20%, if you wish. And that's important. And that's actually something that is good as far as the Bank of Canada is concerned. Because if the wage pressure is coming from beneath, it trickles up. And it's becoming more and more of an issue. If it's coming from the top, it doesn't trickle down. That's what we have seen in the past. So the fact that the wage pressure from beneath is not coming the way it should be, according to Economics 101, is actually welcome news as far as the Bank of Canada is concerned, something to consider.
Okay. Well, that actually takes us to time. So I want to again say thank you very much, gentlemen, for joining us today, sharing your thoughts and your expertise for us on a number of different fronts. I want to say again that we will have recorded this session. We will make it available to everyone who did register, and we'll try and cover off anything out there that is coming up in terms of questions and things like that with that type of information as well. So again, thank you very much for our participants and our panelists for joining us today. It's been a real pleasure. So we'll say goodbye at this point.
Good luck.
Thank you.
Cheers.